Welcome to the deep dive. Today we're tackling a really interesting financial puzzle. How do you actually account for a company you have a lot of influence over, but, don't technically control?
hmm
We are diving deep into the world of what accountants call financial associates. These are the companies where, let's say, a parent company has more than just a minor stake, but it's still less than full-blown ownership.
Exactly. And our guide here, our sort of framework, is mostly the international accounting standards,
Yeah.
specifically
Yeah.
IS 28.
Right.
That's the one that tells groups, so a parent and its subsidiaries, how they need to handle these investments where, like you said, it's about influence, not outright control. That's the key shift in thinking.
That's the hook right there, isn't it? Significant influence. It almost sounds a bit, I don't know, subjective. So what's the official definition of an associate, and how do we figure out when we've crossed that line into having significant influence?
Well, formally, the definition is pretty straightforward. An associate is just an entity over which the investor has significant influence.
Yeah.
Simple as that. But the practical side comes down to numbers, usually. Significant influence is generally assumed. It's a presumption once an investor holds between, say, 20% and 50% of the voting power.
Ah, okay. So that 20 to 50 range is the trigger zone.
That's the key threshold, yeah. Once you hit that 20% floor, this special accounting treatment, we're going to talk about the equity method, well, it has to kick in.
Okay, that 20% threshold is crucial then. But let's dig into that a bit more. Why does hitting 20% suddenly mean influence but not control? I mean, if I own 30%, that feels like quite a bit. What does IA 28 actually mean by significant influence?
Good question. It means having the power to participate. So you can get involved in making decisions about the financial and operating policies of the company you've invested in.
Like getting a seat on the board, maybe.
Exactly. Or having a real say in things like setting major budgets or strategic direction. But, and this is the really vital distinction, it's not control. If you have control, which usually means over 50% ownership, you're essentially calling the shots. You dictate policy. With significant influence, you're just participating. You have a voice at the table. And that difference dictates everything about the accounting. Do you consolidate fully, or do you use the special equity method?
Let's get into the strategic why behind this distinction. If I own, say, 30% of a company, you could argue that economically, 30% of their assets and 30% of their debt kind of belong to me, right?
Yeah.
So why can't I just pull 30% of each line item onto my group's balance sheet?
That's the core issue that equity accounting is designed to address. See, the whole point of consolidated financial statements is to show the resources and the obligations that are under the control of the parent group.
Huh.
If you don't actually control the individual assets or liabilities of that associate company, you can't just decide to sell their factory, for instance. Then you can't really claim them line by line on your own balance sheet. It wouldn't reflect the reality of control.
And what's the practical impact of that decision for the group reporting?
Oh, the strategic consequence is huge, especially for anyone analyzing the accounts from the outside. Imagine if you had to consolidate, say, 30% of all the associates' debt onto your group balance sheet.
Right. That could look bad.
It could seriously skew your group's key financial ratios. Things like gearing or your debt-to-equity ratio could look much worse. By using the equity method, you keep the associates' detailed debt off your main consolidated balance sheet.
So the group looks less leveraged.
Exactly, which can be absolutely critical when it comes to things like bank loan agreements or just general investor perception. It's about reflecting the influence without distorting the group's own controlled financial structure.
Okay, that makes the why much clearer now. It's a specific method to show the economic interest we have, but without taking on the full weight of their balance sheet line items because we don't control them. So let's properly introduce the equity method. How does it actually work in practice?
Right. So the equity method treats the investment differently. It's not just a static asset sitting there at cost. It's seen as an evolving stake in the other company.
Evolving how?
Well, you start by recording the initial investment at what you paid for at the cost. Then, each accounting period after that, the balance of that investment is adjusted. It goes up or down based on the investor's share of the changes in the net assets of the associate company since the acquisition.
Net assets meaning assets minus liabilities.
Precisely. Think of it like you have a running tally. It tracks your slice of the associate's accumulated success or failure since you first invested.
A running tally. I like that analogy. So, okay, let's picture the consolidated balance sheet, the statement of financial position. Since we're not pulling in all their assets and liabilities individually, how does this investment actually show up?
It's actually remarkably neat on the face of the statement. Instead of, potentially dozens of extra lines for the associates' assets and liabilities cluttering things up,
Hmm.
the whole thing is captured in just one single line item. You usually find it under non-current assets, and it's typically called something like investment in associate.
One line. And that single number, that figure, it's not just sitting there at the original purchase price, is it? It's being updated.
Oh, absolutely. It's far from static.
Hmm.
That single figure is dynamic. It represents the original cost you paid.
Okay.
Plus, you add the group's share of all the profits the associate has made since you bought in the post-acquisition profits. Then you have to subtract any impairment losses if the investment's value is dropped,
Right.
and also subtract certain technical adjustments, like unrealized profit on sales between the group and the associate, which we need to talk about. So yes, it's a constantly moving number that reflects the current value of your stake.
Okay, that covers the balance sheet. Now, moving over to the income statement, the consolidated statement of profit or loss, we still want to show that our influence is generating some results, right? How does the associate's performance, its profit or loss, flow into the group's results for the year?
Again, the principle is simplicity
Mm-hmm.
and avoiding that line-by-line consolidation. You don't add the associate's revenue to the group's revenue or their expenses to the group's expenses.
So, another single line.
Exactly. The group's share of the associate's overall result for the period is presented as one single line item. You often find it somewhere after the group's main operating profit. It might be called share of profit of associates or something similar.
And what does that figure represent?
That number is the group's proportionate share, say, are 30% of the associate's profit after tax for that specific period.
Okay, profit after tax. That's important. Now, this feels like where we need to really clarify something that can trip people up. Dividends.
Ah, yes. Dividends.
If the associate makes a profit and decides to pay out some of that profit as a cash dividend to the parent company, well, intuitively, that feels like income, right? Cash received. Shouldn't that show up on the income statement?
It feels like it should, but no. This is probably the most crucial and maybe counterintuitive part of the equity method. When you receive a dividend from an associate, that dividend is not treated as income on the consolidated income statement.
It's not. But why not? It's cash coming in.
Because think about how we just recognized the profit. We already included our share of the associate's profit when the associate earned it. That recognition increased the value of our investment in associate asset on the balance sheet.
Okay, right. We recognize the profit as it was earned, which increased the investment value.
Exactly. So when the cash dividend is actually paid out later, it's considered to be just a delivery or a return of that profit we've already accounted for.
Ah, I see. It's like getting back money you already recorded as yours.
Precisely. So the accounting treatment is that the dividend received reduces the carrying amount of the investment on the balance sheet. It happens in the working papers. Think of that running tally again.
Okay.
You recorded your share of the profit, increasing the tally. When the dividend comes in, you reduce the tally by that amount. The net effect on the investment value reflects the retained profit still inside the associate. It's not new income. It's just receiving cash from the value you already recognized.
That actually makes perfect sense when you explain it that way. The running tally analogy holds up. The single line reporting, both on the balance sheet and income statement, really emphasizes that we're accounting for our stake, our share, not the underlying transactions of the associate itself.
That's the essence of it.
Yeah.
Influence, not control.
Okay. Now let's get into what you call the messy part, trading between the companies.
Right. Intercompany transactions.
We know the standard rule for a parent and its subsidiary. If they trade with each other, you eliminate everything on consolidation, the sale, the purchase, any amounts owed between them, and crucially, any profit made on goods still held within the group. What happens when the trade is between the parent, let's say, and the associate?
This is where that fundamental difference between control and influence really bites, accounting-wise. Because the associate is technically considered to be outside the core consolidated group. We treat the balances differently. Any amounts owed, payables or receivables between a group company and the associate, they actually remain on the consolidated balance sheet. They're not canceled out.
Hold on, that feels really counterintuitive. Let's use the example from the source material. Dipsy's the parent, Poe is the associate. If parent Dipsy owes associate Poe some money, that liability stays on Dipsy's consolidated accounts.
That's right. It's treated like a debt to a third party because Poe isn't part of the controlled group entity. And it's the same for the income statement impact.
Meaning?
Sales from the group to the associate or purchases by the group from the associate, those figures are generally not eliminated from the group's consolidated income statement totals for revenue or cost of sales.
Wow. Okay. So the only thing we do need to adjust for is the profit element.
Exactly. The big adjustment is dealing with any profit that might be sort of stuck inside inventory that hasn't been sold on to an external party yet. The unrealized profit, or PUP.
Right, PUP. Dealing with unrealized profit in inventory that's complex enough even within a normal parent-subsidiary relationship. How on earth do we eliminate that profit element when we only influence the company holding the inventory? We don't control it.
We apply the same logic as for the share of profits. We only take responsibility, you might say, for eliminating the profit that relates to our share of the influence.
Okay.
This is really the equity method principle in action again. You calculate the total unrealized profit on the goods held by the associate that were bought from the group. But then you only adjust for it to the extent of the investor's interest.
Let's run that 30% example again, just to make sure we've got it. Slow it down for us.
Okay. Let's say parent Dipsy sells goods to associate Poe. Dipsy made a hefty profit, say a 25% markup on cost. At the year end, Poe hasn't sold all of those goods yet. Some are still sitting in Poe's inventory.
Right. So there's unrealized profit sitting in Poe's warehouse.
Correct. Now, if Dipsy owns 30% of Poe, first we calculate the total amount of Dipsy's profit embedded in that unsold inventory held by Poe. Then we only adjust for 30% of that total figure. We only eliminate the group's share of that internal profit.
So we don't wipe out the whole unrealized profit, only the 30% slice that relates to our ownership.
Exactly right. And that 30% reduction hits two key places in our consolidation workings.
Where?
First, it reduces that share of profit of associate figure we talked about on the income statement. It lowers the profit we recognize from Poe for the year.
Makes sense. Removing the internal profit element.
And second, it also reduces the carrying value of the investment in associate asset on the consolidated balance sheet, that running tally.
Ah, okay. So it flows through both statements proportionally.
Yes. It's a continuous, proportionate reflection of our economic interest. We're basically saying our group's reported profit should only include profits earned from outside the sphere of our influence, or at least we need to strip out the internal profit to the extent of our stake.
That really, really drives home the difference between full control consolidation and this influence-based equity accounting.
Okay, beyond the complexities of trading, what about just the basic value of the investment itself? Does it need checking?
Oh, absolutely. Like any significant asset, that investment in associate figure on the balance sheet can't just be taken for granted. It has to be rigorously tested for impairment. Impairment, meaning checking if it's lost value.
Yes. If the group determines that the recoverable amount of the investment, what it's actually worth, either through use or sale, is lower than the value currently recorded on the balance sheet, that running tally,
Then what?
then an impairment loss must be recognized. That loss directly reduces the investment asset balance on the balance sheet.
And where does the other side of that entry go? Does it hit the group's profit?
Yes, it does. That impairment loss flows through to reduce the parent group's retained earnings, usually via the income statement, reflecting that diminution in value.
Okay. And one final accounting detail you mentioned earlier, fair values at the start.
Right? Can't forget that. Fair value adjustments at acquisition. If, when the group first bought its stake in the associate's own balance sheet didn't reflect the true fair market values of its assets and liabilities, maybe they had some land recorded way below market value, for example,
Yeah.
then we need to notionally adjust the associate's net assets to their fair values at that acquisition date. We do this before we even start calculating our share of their post-acquisition profits and changes. It's the same principle as for subsidiaries. You need to start the clock based on economic reality from day one.
Got it. This really paints a picture of how complex modern corporate structures can be, needing these different accounting methods side by side. The source material actually gives us a nice, simple example to visualize this. The Dipsy, Lala, and Poe group.
Yeah, it's a great little example because it perfectly shows why you often need both methods running at the same time within one set of group accounts.
So run us through it.
Okay, you have parent Dipsy at the top. Dipsy owns 80% of another company, Lala.
80% is definitely control.
Absolutely. So Lala is a subsidiary. For Lala, Dipsy uses the full line-by-line consolidation method, brings in 100% of assets and liabilities, then accounts for the non-controlling interest. Standard stuff.
Okay.
But then Dipsy also owns 30% of another company, Poe.
And 30% falls smack bang in that 20% to 50% influence zone.
Exactly. So Poe is classified as an associate. For Poe, Dipsy must use the equity method we've just spent all this time discussing.
So in Dipsy's final consolidated financial statements, you've got Lala, fully consolidated, and Poe showing up as just that single investment in associate line and the share of profit line.
Precisely. Two different relationships, two different accounting treatments, all rolling up into one group report. It shows you have to understand the nature of your power or influence over each entity you invest in.
Makes sense. Now, we've leaned heavily on that 20% to 50% rule of thumb. But are there situations, exceptions, where a company might hold, say, 35% of another, but for some reason the equity method is not used?
Yes, there are a couple of key exceptions laid out in the standards.
Like what?
Well, first, if that investment, even if it's 35%, is formally classified as held for sale, according to another standard, IFRS 5, that means the group has a concrete plan to sell it off relatively quickly.
Ah, so if you're about to get rid of it, you stop adjusting the value dynamically.
Essentially, yes.
Hmm.
You switch to a different accounting treatment under IFRS 5. The second main exception is if the parent company itself is actually exempted from preparing consolidated financial statements altogether.
When would that happen?
It might be because the parent is itself a wholly owned or partially owned subsidiary of another higher-level parent company that does prepare consolidated accounts available for public use. In that case, the intermediate parent might get a pass.
And therefore wouldn't need to apply the equity method to its own associates either.
Correct. The requirement flows down from the ultimate need for consolidated reporting.
Okay, that's useful to know. So just to summarize the absolute core distinction for everyone listening. For subsidiaries where you have control, it's full line-by-line consolidation. You bring everything onto your books because you control it all, including 100% of their debt potentially impacting your ratios.
Right.
But for associates, where you only have significant influence, it's the equity method. Single-line reporting on the balance sheet and income statement, reflecting your share of their changing economic value, keeping their detailed debts off your main balance sheet.
That's a perfect summary. And what I find really fascinating about all this is how the accounting rules genuinely try to mirror the underlying reality of corporate power dynamics.
Oh, so?
That investment in associates past. Balance the fact that it's this living, breathing number that changes constantly based on the associate's performance. It really reflects the group's proportionate ownership of the future economic results of that associate. You're not just tracking a historical cost. You're tracking your ongoing stake in their fortunes, driven by your influence.
So the accounts become almost a reflection of governance structure, not just pure finance.
I think so, yes.
Yeah.
We're mapping influence, not just counting shares.
Which brings us to a final, maybe slightly provocative thought for you, the listener, to ponder. We've talked about the 20% to 50% guideline, but we also know that, say, a 25% shareholding might give you huge practical influence in one company. Maybe you get to appoint one director on a small 4-person board, giving you significant sway.
That's a specific indicator mentioned in IAS 28.
Right. But that same 25% in another company, maybe one with a massive diverse board and complex shareholder agreements, might give you very little real say in practice.
True.
So the question to mull over is this. How often is significant influence in the real world truly driven by that quantitative 20% shareholding threshold versus the specifics, maybe unwritten rules, maybe specific contractual rights, maybe just the personalities involved, the actual governance structures that truly define the power dynamics between investor and investee?
That's the gray area, isn't it?
It is. And that's something for you to perhaps look for between the lines the next time you're looking at a complex group's annual report.